Okay, good to be here with you all. We are going to talk about exchange. The only purpose of a good money is if you can exchange it at some point with something else. And a lot of companies have risen, have fallen, have collapsed, have exploded, have made gazillion dollars building the exchange services that we all use. So we're going to talk about that and what it looks like going into the future. And real quick, I want to start with each of you telling me very quickly what your company does, why it's cool, and why you got involved with Bitcoin from a first principles perspective, right? So keep it to 30 seconds each on this. Start with you, Yanni.
Etoro is the largest social trading network in the world with 20 million registered users who can trade cryptocurrencies alongside commission-free stock trading in a social network where everybody can see, follow, and automatically copy the most successful investors. So it's cool because you don't need to understand how to trade. You can simply copy the best. That's how I succeeded in high school. What brought me to Bitcoin, so we founded Etoro pre-Bitcoin in 2007. I started writing about electronic money post-financial crisis 2008. And then when I saw Bitcoin in 2010 and started buying and paying people in Bitcoin talk, I just fell in love with the technology, similar to how I fell in love in the stock markets and in the internet when I was young.
Cool, great. Sam.
Yeah, FTX is a global crypto exchange. We're one of the bigger ones, not the biggest yet. We have a bunch of different products, and I think one of the coolest things about watching it grow over the last few years has been just watching the rate at which sort of our team's been able to roll things out. There will be times when we'll see a bunch of demand pop up on Twitter for a product and hope to have it live that night, and sometimes we make it. Anyway, great to be here. And I originally got into crypto just as a trader, so it seemed like a good area to be in. But it wasn't until I attempted to get a bank account while in crypto that I started to learn why maybe there was some impetus to try out a new financial set of rails.
And hey, Caitlin Long from Wyoming, all things Wyoming. And thank you. And I'm not an exchange. Avanti Bank is a bank. It is designed to fix some of the problems that Sam just talked about. We are a chartered bank, but we are not yet operating. Should be soon, and doing the hard work of getting integrated into the Federal Reserve. So we have a native company from this industry that has direct connectivity to the Federal Reserve. Stay tuned, hopefully soon. And got into Bitcoin because during the financial crisis, I understood the settlement problems that were happening on Wall Street were part of the cause of the financial crisis, and that this technology can solve that.
Awesome. All right. So we're going to go with that topic for a second. We are at the point now where some exchanges are quite literally becoming banks. I believe Kraken is now a bank in Wyoming. Coinbase is pretty damn close to being a bank if they're not one already. This is to you, Caitlin, is this a progression or is this a regression?
It's a progression because the big problem and why US dollar payments get hung up in the crypto industry is that the dollar does not settle on the same speed and finality terms as crypto. And that's why stablecoins were invented, precisely to match the speed and finality terms of crypto. But even stablecoins are still indirectly connected to the Federal Reserve. Somebody is still processing those US dollar payments. And let's face it, we're still seeing banks closing accounts for legitimate companies in this industry. And somebody needed to go directly to the Fed and make the case and lay out exactly how you plug this technology into the payment system without potentially blowing it up. And one of the challenges, of course, is that digital assets settle on a very quick settlement cycle relative to US dollars. And the impact of that is, let's say, for example, if the accidental fork in Ethereum in November had lasted more than a couple of hours, and you had to actually have a mass redemption of the ERC20 stablecoins that were issued on the fork that did not become the longest chain. At the time, we were, 20 billion or so of stablecoin assets. The US dollar banking system would have been able to handle a sudden withdrawal within minutes or hours of 20 billion. We're now at, 90 billion in stablecoin assets? And a sudden withdrawal of that, if you have an accidental fork that no one was expecting, starts to become a place where you can have some financial risk enter into the system. And those are the sorts of things that we're solving and working, doing the hard work of working with traditional financial services regulators on these exact issues.
All right. So this one is to Sam. So there is a saying in finance that liquidity begets liquidity. And traders will thus go where the volume is, which begets more trading. And this would suggest that the Bitcoin exchange market should tend to consolidate, that you would tend to get a consolidation of liquidity into one or a few large exchanges. And yet we empirically have seen the opposite of this over Bitcoin's history. There are more Bitcoin exchanges today than ever before. Why has there not been a clear winner-take-all in the Bitcoin exchange market thus far?
So I'm going to actually partially disagree with that. There has not been a clear winner-takes-all, but if you graph percentage of volume over time by exchange, you can see really clear trends. And especially over the last 3 or so years, there has been a ton of consolidation. The space is done so well that even the shrinking exchanges are still doing well. They're not shutting down. So you don't see a decrease in the number of exchanges, but you are starting to see an increase in the concentration of volume in the top 5 or so exchanges. Something like 75% of global volume is trading in the top 5 exchanges. And so there is a very long tail, but you're definitely seeing consolidation there. One thing I will tack on to that, though, is the localization of the fiat ramps. And, Avanti's doing a ton of work, as are a number of other people, in trying to make, the US financial system plug in a much cleaner way with the crypto economy. But there's 200 jurisdictions in the world, and there are lots of different currencies, and each one of those involves, its own lengthy, distinct process that you need to repeat. And so what you see, and that's one side of this, there's localization, language barriers, culture, and because of that, you do see a bunch of regional exchanges. And there are some exchanges that are doing phenomenally well, just focusing on one jurisdiction. So you do still see some spread out activity based on, you see Upbit, Bithumb, others in Korea, right? You see Bitflyer, Bitbank, and others in Japan. So you still do see a bunch of very successful regional exchanges, which diversify a little bit. But if you look at the global landscape or the Western landscape, there actually has been quite a bit of consolidation over the last 3 years or so.
Okay. And this one also is to you, Sam. So DEXs are obviously a hot topic. According to CoinGecko recently, DEXs are about 5% of trade volume, something around that, and it was definitely less than 1% about a year ago. What do you see currently today as the relationship between the centralized Bitcoin exchanges and these decentralized exchanges, which are growing very rapidly? And maybe mention a little bit about FTX and also the decentralized product that you guys are building.
Yeah, so there's been really big growth in DEXs, but it hasn't gotten to the scale of centralized exchanges yet. So you don't currently see a very strong competing effect. Right now, they're mostly filling different use cases. I actually don't think long term that they're going to be completely in competition with each other. There are uses for one, there are uses for the other. The idea of having an entire industry, a business and application running natively on a blockchain is really exciting. And you get this really great composability and kind of Cambrian explosion of apps from it. And so I think that's really exciting. Don't take that, though, as a statement that all current DEXs are perfect. I think that is very far from the truth. And I think some people will say, hey, you know, the DEXs are about to overtake the banks. You know, they better watch out. Anyone from traditional finance who tries to use a current DEX will know that's not true. Will know that we have a long way to go before everything from the user experience, the regulatory structure, the UI, the speed, the throughput, the cost of DEXs gets to the point where it can sort of meet mass demand. But even beyond that, they're never going to be the highest throughput things in the world. You have this fundamental speed of light constraint, among other things. It takes 100 milliseconds for light to get around the world. You can't have latency of a nanosecond on a DEX, no matter what you do, not if you actually want a geographically distributed consensus. And so because of this, there's a bunch of activity that is never really going to make sense on DEXs. And so I do think that there's separate areas for them. But you know, when you do look at the DEX space, what are some of the advantages? Anyone who's tried to take two centralized businesses and glue them together has probably more than a few gray hairs on their head. And anyone who's done that with two decentralized products might or might not have a few gray hairs on their head, but there's a hope it went well. And it's one of the beautiful things about using sort of compatible protocols is that you can glue them to each other. They can be completely permissionless. You can prove exactly what they will do. You don't have to worry about counterparty risk in the same way with the DEX. So I do think that there's really, really huge upside as that industry continues to build out. You know, I think something that we've been thinking about is just, you know, FTX is not a DEX. It's not a decentralized product, and that's not what it's meant to be. We're trying to build the best centralized exchange we can. But separately, you know, we've been active in the DeFi ecosystem, in the Solana ecosystem, especially because we do think that's another huge area. And I mean, I think everyone's sort of heard me say this multiple times, but I think throughput. When you're talking about trying to put an exchange on a blockchain, you need to have the throughput, the TPS that an exchange uses. If you want it to get huge, you need to scale up to hundreds of thousands to millions of TPS.
Thanks. Yoni. So, so I've known you for many years, and eToro got started pre-Bitcoin. Tell us a little bit about how, you know, your journey with Bitcoin and how you ultimately got eToro involved in Bitcoin trading and what that was like. Like, what tipped the scale there?
I've been personally passionate about Bitcoin. We bought some Bitcoin in 2011 for the company, had a lot of arguments with some of my investors regarding whether Bitcoin makes sense or not. And then perfect timing, we launched Bitcoin on eToro in 2013, a month before Mt. Gox collapsed. And then for about 4 years, really only about 1% of eToro customers bought Bitcoin. And then the crypto rally of 2017, at the end of the year, we were at 90% of eToro users own crypto. So today, the majority of eToro clients own both equities and crypto. We believe that most millennials are going to own Bitcoin and crypto assets as part of their investment strategy. So our view is very much an investment view of this ecosystem, in addition to the fact that we're big believers in blockchain, DeFi, etc., but it's going to be still hard to figure out how to glue DeFi and centralized regulated entities.
And one question I'm curious about is, with you and your large retail user base, what percentage of them, if you're willing to share, do you believe own Bitcoin because they understand what it's doing, why it's powerful, why it's important, how it's changing the world, versus those who are buying it because they want the number to go up, right? So it's obviously a mix of both. Do you have a sense of what portion of them are, you know, let's call it sophisticated in their understanding of why Bitcoin exists?
I would generally say most of Bitcoin investors are investing because they believe or understand something. That doesn't mean they're proficient in Bitcoin. I would say that the majority, a significant part of our customers have never transacted an on-chain transaction, which is, by the way, complex for a lot of people out there. I assume here in the room, everybody can use their ledgers and treasures and do on-chain transactions, but most people find it actually difficult to do on-chain transactions. So we simplify that to a lot of people. Therefore, a lot of them won't necessarily understand how blockchain technology works, which is why also we developed the Good Dollar project to help people understand how that works as well. So I think a lot of people are investing in it because they believe in the macro crypto asset as a hedge against governments, as a deflationary asset, and that's why they're investing.
Cool. All right. So one of the things that bothers me about Bitcoin's development is that it is the greatest decentralized system that mankind has ever built. And yet it has this profound centralization in terms of the exchanges, right? We have this huge centralization risk. And no one has really solved that. It's kind of one of the major flaws in how Bitcoin has developed so far. Caitlin, do you see this getting better? Is this something that can be solved? And if so, how? Is this always going to be a giant pockmark that we have to deal with?
I'm optimistic about DEXs because that does actually keep with the decentralization ethos. There have been, I guess if I step back, the way I would lay it out is we're making some of the same mistakes that the traditional financial services industry made. The reason why we don't like traditional financial services companies generally in this industry is because of the information asymmetry, where the traditional financial services company is the holder of the information, and you cannot have perfect markets if you don't have perfect information. And the intermediaries in this industry are not doing proof of reserves. They're not voluntarily disclosing their financial statements so you can understand the counterparty risk associated with them. And they're not disclosing the probability of losses on the products that they're offering. And in some cases, with 100 to 1, 125 to 1 leveraged futures contracts, the probability of loss is in the high 90 percentile. And would people actually trade those if they knew that they were virtually guaranteed to lose money? I think there are probably a lot of innocent people who are way beyond their skis, and if we actually disclosed that information, you may see a lot fewer people losing money.
Well said. And tell us a little bit about Avanti and its commitment to being full reserve and what that means as a bank. And do you believe that other banks might follow your lead, or do you look totally weird to them?
A lot of this really stems from the ethos of Bitcoin. Satoshi gave us money that isn't debt. And philosophically, why would you put debt on something? I like to use the phrase, a fool and their leveraged Bitcoin are soon parted. Again, a fool and their leveraged Bitcoin are soon parted. And the excesses that we've seen in this bull market are coming from a lot of leverage that didn't happen in the previous bull market, right? We had the ICO issue in the previous bull market. This bull market, it's leverage, right? We've seen more volatility. And one of the big issues with that is that even those of us who are not leveraged have the downside of the fact that the price is more volatile precisely because of the running of stops in these leveraged drawdowns, which we've just seen over the last month. It increases the cost of capital for everybody in the industry when Bitcoin's price is more volatile as a result of the impact of leverage moving it around. Avanti is fundamentally committed to not using leverage. And if you're interested in understanding why, philosophically, I really would encourage you to go read Mises. Go understand the difference between commodity credit and circulation credit. Commodity credit is absolutely fine. It's not leverage. Going one-to-one leverage is fine. Anything that is circulation credit that goes above 1 times leverage, in other words, certainly 100-to-1 leverage is is 99% circulation credit, right? That is creating claims to the underlying out of thin air. It is fractional reserve banking. And we are fundamentally committed to not doing that. It is ultimately a commitment to solvency instead of liquidity. And what we've seen in this bull market is a lot of folks are obsessed with liquidity. Satoshi didn't create anything that was designed to be leveraged. And really didn't care about liquidity. One of the biggest takeaways that I have from this conference is what Nick Szabo said yesterday, when he said liquidity is a nice to have for a store of value, but not a necessity. You need to be able to use it when you need it, but do we need all this daily liquidity that's driven by trading? Go back and listen to Nick's speech and go read your Mises and learn about circulation credit.
Sam, do you agree?
Nah, I mean, I agree with parts. I think not with a lot of it. I guess it's not shocking. I have a
Tell us
bunch of
specifically
thoughts on
about
that.
leverage from your perspective on
Yeah.
this topic. Yeah.
So one thing I just want to say is that I think a lot gets blamed on 100x leverage, and I think it's sort of exaggerated. 100x leverage is not very important for any parts of the crypto industry right now. It's a tiny fraction of even the exchanges that have it, and it's not what causes the volatility that you see. The sizes that get liquidated on those positions are tiny. It's not what drives the big moves. The big moves are driven by big positions. And when you're talking about big positions, you're talking about low or no leverage. Leverage does absolutely play a role in it, but you're talking 3x, 5x leverage, not 100x leverage. 99% of the positions are in that lower range. Again, not trying to say leverage doesn't play a role in it, just that I think this sort of discussion about very high leverage is mostly a red herring. I do think there's a legitimate point about the volatility caused by leverage. It does cause volatility. That is undeniable. Liquidations cause leverage. I think that there's this side point people make about losing money because of that, and a lot of people have lost, and you should absolutely never put on a leverage position with more money than you are comfortable losing, because you might lose it, especially in a volatile market. That having been said, there's a difference between mean and median here, which I think is getting swept under the rug, right? And this is the same Petersburg's paradox, right? Where you could have a strategy that has completely decoupled probability of ending up above zero and expected value of net return. And the expected value is ultimately the more important concept there. Now, that's not to say you're not negative EV if you're doing 100x leverage, but you have to go further than just talking about probability of loss, right? If you have a 10% probability of 10xing and a 90% probability of going to zero, that's not a negative EV position to have on, right? And that's absolutely not something that you should do with a greater amount of funds than you're willing to lose. But that's not, doing that with 10% of your funds as collateral is not different than putting 100% of your funds in at 1x leverage, right? In fact, it's probably lower downside risk in some ways. And so if you reframe this from thinking about putting on too big of a position to not having to place as much of your capital at risk in order to put on the same size position, it changes the perspective on it a little bit. Again, not trying to say leverage doesn't play a role in this, just I think it's a lot more nuanced than that. And I'll just say one last thing, which is, look, you can take the position leverage is bad. I don't believe that, but one could believe that. It's not a crazy thing to think. However, were you to think that, I think you'd probably also have to be willing to sacrifice more than most people realize in order to get there. I think you have had to sacrifice the majority of the growth that the industry has had to date if you were to make that trade, and that might be worth it, right? If you think that it is very bad to have leverage in the system, that might be a trade-off worth having. But you can't just look at the drop from 60K to 40K and blame it on leverage without remembering that the run-up from 10K to 60K involved leverage
Absolutely,
as well. And we ended up higher than we started. And so just think about what you're throwing out, you know, with the bad parts. You know, think about the collateral damage.
Well said. All right. So we just have a few moments here. I want to throw up a softball question that any of you can take. Are exchanges at risk of evolving into just another tool of state surveillance? What can be done to prevent that? And do we, as builders of exchanges, have a moral obligation to protect user privacy?
And so the question is about them becoming just like instruments of states to, you know, I think that like one thing I'll say is some absolutely will. There's nothing we can do that will make it the case that no exchanges are going to become effectively nationalized. We are already seeing it with some exchanges. There's nationalization going on with some of them. What can we do to combat that? First of all, have multiple exchanges, right? Don't put all your eggs in one basket. Even if one gets quite large, have others on standby so that you can move to one that you feel comfortable with if you cease to become comfortable with one of the current ones. I think that's just a key piece of this. And I think that's one of the problems that you see with the traditional financial ecosystem is that there's this extremely closely guarded ability to move a US dollar around, right? You can't hold your own dollar and send it yourself to someone. You have to rely on an extremely closely guarded list of ultimate counterparties to do that.
Yep.
And that means that you can't have a competing system to moving dollars around that tries to do it in a more efficient way or in a way that one feels more comfortable with. And I think that's one of the core problems is that you can't have an alternative to some pieces of the existing system. That's where all the pain comes from. And I think that our strength as an industry is the fact that we can build so many copies of this and we can have so many independent sources of exchangeability that people have choice.
All right. We've got to wrap it up there, guys. Thank you for joining me on stage today.
Thank you.
And thank you all for caring about Bitcoin.